Welcome to the Deep Dive, the only show that takes these, well, complex piles of source material, distills them all down to their potent essence, and delivers it straight to you, the learner. Today, we are diving into an institution that is, and I mean this literally, foundational to American finance.
Absolutely.
It was founded by a key figure in U.S. history, yet it operates today at a global scale that very few people, even folks inside the financial industry, truly grasp. We're talking about the Bank of New York Mellon Corporation.
Or BNY, as they're now calling themselves.
BNY, right, a much simpler name.
That's right. And when we talk about the architecture of global finance, BNY isn't just, a floor or a wall. It's the entire foundation. It's the plumbing running under everything.
Well, it's an infrastructure company.
It's an infrastructure company completely disguised as a bank. Our mission today is to track this extraordinary evolution from an 18th century Revolutionary War era venture literally financed by Alexander Hamilton to this modern financial titan. We have to focus on its defining role as the world's largest custodian bank. The goal here is to understand not just the history, which is fascinating, but the sheer staggering magnitude of its operations today.
And you're not kidding when you say staggering. I mean, we have to introduce the number. There's one number that I think completely reorients your perspective on what this company even is.
It's the anchor for this whole discussion.
It is.
Yeah.
This isn't just a big bank that, makes commercial loans. This is a global safekeeper of wealth. So what's that key figure? What defines their role in the world?
It all comes down to AUCA. That's Assets Under Custody and Administration.
AUCA. Got it.
As of late 2024, BNY made history. They became the first bank ever to surpass the $50 trillion mark in assets under custody and administration.
50 trillion.
50 trillion. It's a number that's almost meaningless. It's so big. It represents a massive, massive percentage of the world's investable wealth. And it just puts BNY at the absolute pinnacle of global financial infrastructure.
When I hear 50 trillion, I don't just hear a number. I hear a global percentage of wealth. It's how does a bank even handle that kind of cognitive, that kind of technological burden?
Well, that's the story.
Let's unpack the history of how they accumulated that trust, so starting with the founder who we all know from history class.
Let's go back. We begin in June 1784.
Okay.
The Revolutionary War had just ended. New York City was absolutely booming, but its commercial and shipping industry was just severely hindered by the lack of a bank.
There was no financial engine?
None. People were looking over at Philadelphia, at the Bank of North America, paying out these 14% dividends, and Boston with the Massachusetts Bank, and they were, frankly, jealous. New York needed its own.
And the result of that need was this crucial meeting at the old Walton Mansion. Some sources say the old Merchant's Coffee House.
Right, on St. George's Square.
And that leads to the official formation of the Bank of New York, or BONY as it was called. But the really wild historical detail here is that this very prestigious venture, it operated without a legal charter for 7 years.
7 years. It was basically a startup built entirely on good faith.
Just on reputation.
And the overwhelming prestige of its founders. They were signing a Constitution of Association, not getting a legal mandate from the state. And one of those founders, of course, was Alexander Hamilton.
Hamilton was the chief advocate. The sources we have really detail the initial financial setup, which gives you this amazing microscopic look at early American investment.
That's incredible.
The initial plan was actually pretty ambitious, right? They were aiming for $750,000 in capitalization.
Yeah, with a mix of cash and mortgages. But that proved a little too rich for the initial investors.
Not too much.
So the final initial offering was reduced to $500,000. And critically, this is a key point, it had to be paid strictly in gold or silver coin.
No paper.
No paper. It shows this foundational desire for hard assets, for stability, right from day one.
And that early shareholder list, it's like a who's who of the new nation's elite. It was a very exclusive club.
Oh, absolutely. You look at that list, you see all the major names. Aaron Burr, Hamilton's eventual rival.
He had shares?
He held 3 shares. Hamilton himself held 1.5. It's just amazing to think that those initial investments directly connect the individuals who shaped the country to the institution that's still, helping run global markets today.
It's a direct line.
Yeah.
And it connects them physically to the history. BNY got to work immediately. Right. They were operating out of the old Walton Mansion until 1787. But the moment of national significance, the event that I think truly solidified BNY's role in the New Republic, That came in 1789.
The first loan.
The very first loan BNY made to the United States government. And it was orchestrated by Hamilton, who by then was the nation's first Secretary of the Treasury.
And this loan wasn't for some, future infrastructure project. This was absolutely critical for the nation to even function. That money paid the back salaries of the members of Congress and President George Washington.
So BNY was literally the source of cash that kept the government running.
Literally. It's this early, profound example of the bank being completely interwoven with the financial lifeblood of the new nation.
And the string of firsts just keeps going. BNY was also the first company ever listed on the New York Stock Exchange when it opened its doors in 1792.
A true lineage institution.
But, early success, it always breeds rivalry, which brings us right back to that foundational friction with Aaron Burr.
Yes. For 15 years, BNY had a total monopoly on banking services in New York City. A complete monopoly.
Wow.
That changed dramatically in 1799 when Aaron Burr sought to break that monopoly. He founded the Bank of the Manhattan Company. And Hamilton and BNY, they vigorously, sometimes aggressively, opposed the founding of Burr's institution.
This wasn't just a political disagreement, was it?
No, this was a battle for economic control of the most important commercial city in the nation. It just shows you how these high-stakes financial power struggles are baked right into BNY's DNA long before the famous duel.
Okay, so moving into the 19th and early 20th centuries, BNY gets this reputation, almost a saintly one, for financial stability.
Yeah, it's famous for its conservative lending practices.
What did that mean in practice?
It meant it successfully navigated and weathered virtually every major financial crisis of the era. The Panic of 1837, 1857, you name it, they survived it.
And that stability allowed it to serve the country in these really profound ways. BNY was instrumental in financing critical infrastructure that, defined American commerce.
Like the Morrison-Erie canals.
And early steamboat companies connecting the interior of the country to the coast.
It also acted as a key financier for major war efforts. It funded the War of 1812 and later served the Union Army during the Civil War.
And after the Civil War.
It just kept going, financing massive urban projects like utilities, railroads, even the construction of the original New York City subway system. That continuity of purpose, just funding the gears of commerce. It's astonishing.
So that bedrock stability, that really set the stage for major growth through acquisition in the 20th century. This wasn't just organic growth. This was a deliberate strategy to achieve critical mass.
Exactly. And that would all culminate in the big 2007 merger. But the expansion started way earlier. In 1922, they merged with the New York Life Insurance and Trust Company.
Which cemented their role in wealth management.
Right. And they also successfully navigated the Great Depression, which is an almost unheard of feat. Their total deposits actually increased while they consistently paid dividends.
Incredible. And more mergers followed.
Fifth Avenue Bank in 1948, Empire Trust Company in 1966. But the real appetite for scale, that kicked in toward the end of the century.
The 1988 acquisition of the Irving Bank Corporation really stands out here. This wasn't a friendly handshake deal.
No, it required a grueling, year-long takeover bid. It was a true corporate battle.
And what was the price?
Irving's iconic headquarters. One Wall Street became BNY's new home. That acquisition marked a huge shift in scale, but the real aggressive strategic pivot that happened in the 90s. Between 1993 and 1998, BNY executed 33 acquisitions.
33. And what was the most crucial strategic move among all of those?
For me, it has to be in 1995. They acquired JP Morgan's global custody business.
Okay, why was that so important?
Because this wasn't about traditional banking anymore. This was the strategic moment where BNY decided its future wasn't in competing with, universal banks. It was in becoming the world's vault, the world's record keeper.
And this focus was cemented just before the big merger. The $2 billion acquisition of Pershing LLC in 2003.
Yeah, that was Credit Suisse First, Boston's stock clearing unit. And the Pershing acquisition was it was transformative. It immediately made BNY the nation's largest clearing firm for stock trades.
So it consolidated their position in the back office.
Completely. They moved decisively into these specialized fee-based financial services and away from volatile lending.
Now let's pivot. Let's look at the other half of this coin, the Mellon legacy. While BNY is sunding canals and fighting Burr in New York, the Mellons are over in Pittsburgh, building a financial dynasty squarely on American-heavy industry.
Absolutely. The Mellon story is pure Americana. It starts in Pittsburgh, Pennsylvania, 1869. Founded as T. Mellon and Sons Bank by the recently retired Judge Thomas Mellon and his sons.
And their core identity was different.
It was all about providing the capital needed to fuel the American Industrial Revolution.
And they didn't just invest. They founded giants. The sources highlight Mellon's foundational role in investing in and helping launch some of the most massive names in American manufacturing.
I mean, the list is incredible. Alcoa, Westinghouse, Gulf Oil, General Motors, Bethlehem Steel.
And Gulf Oil and Alcoa are specifically noted in our sources as their two most successful investments.
Imagine a bank being so intrinsically linked to the physical production of aluminum and oil. It was just synonymous with the industrial rise of America.
Over time, the structure evolves. It goes from a family bank to a major national player.
Right. It became Mellon National Bank in 1902. And after merging with the Union Trust Company, it became the Mellon National Bank and Trust Company in 1946. At the time, that was Pittsburgh's first $1 billion bank.
And just like BNY, they were pioneers. Mellon formed the first dedicated family office in the United States back in 1971.
A crucial move. It established their expertise in managing the wealth of the ultra-high net worth. That's a business model BNY Mellon relies on heavily today. They also acquired major firms like the Boston Company and the Dreyfus Corporation mutual funds in the early 90s.
But the parallel strategic decision between BNY and Mellon is really the key here. Both of them chose to get out of traditional consumer banking. Mellon sold its retail branches and assets to Citizens Financial Group in 2001.
And that move was a clear strategic signal. Mellon was moving decisively towards high net worth management and institutional services. They were jettisoning the branch network, the volatility of retail deposits.
And this set the stage perfectly for the eventual union with BNY.
Who had made similar choices. They were two highly specialized complementary giants just waiting to come together.
So we have BNY, the New York custody and clearing powerhouse, and Mellon, the Pittsburgh wealth and asset management giant. Both had shed their retail identities. Both were focused on institutional services.
So the merger was announced, December 2006, and the rationale was brilliantly simple. You combine BNY's immense asset servicing capabilities, the safekeeping and administration of assets, with Mellon's sophisticated wealth and asset management.
And a goal.
The $16.5 billion deal was designed to create the world's largest securities servicing company, to achieve an immediate scale advantage that no one else could touch.
It was a massive undertaking. And like most mega mergers, it came with the inevitable cost-cutting projections.
They expected to save approximately $700 million and cut around 3,900 jobs, mostly through attrition and just reducing overlap.
And the merger was finalized on July 4th, 2007.
Perfect timing. Within 15 months, the 2008 financial crisis hits, and this newly formed company immediately takes on a critical national responsibility.
And this is where that conservative, centuries-old reputation really paid off. The U.S. Treasury, in October 2008, named BNY Mellon the master custodian of the TARP bailout fund.
The Troubled Asset Relief Program. This was a critical appointment. They weren't funding the bailout.
Right, they weren't the ones putting up the cash.
No, they were being trusted to handle the administrative load. The essential, meticulous work of accounting, tracking, and record-keeping for the entire $700 billion program.
And they won this through a competitive bidding process.
Proving they were the most reliable neutral party for what was basically the world's most complex bookkeeping job.
And even while they're performing this critical government function, BNY Mellon itself received $3 billion from TARP, which they then repaid in full by mid-2009.
That swift repayment and their performance in the subsequent regulatory tests, it really speaks volumes about their underlying stability compared to other major banks.
Yeah, that's a key distinguishing factor. In the 2009 stress test conducted by federal regulators, BNY Mellon was identified as one of only 3 banks that could withstand a worsening economic situation.
And they performed similarly well in the Federal Reserve's later Dodd-Frank stress tests in 2013 and 2014. They consistently ranked among the least affected by these extreme, hypothetical economic scenarios.
But let's introduce some critical friction here. Is BNY passing these stress tests because they're uniquely brilliant and well-managed? Or is it simply because their core business model, custody, not high-risk lending, inherently shields them from the kind of liquidity risks that killed a place like Lehman Brothers?
That is a crucial question.
Are they in some ways being tested against the wrong metrics?
The reason BNY passes these tests is deeply, deeply rooted in its business model. Custody banking is a fee-based revenue stream. They earn money by safeguarding and administering assets, not by taking huge risks with their own balance sheet like a traditional investment bank would.
So their risk is different.
Their primary risk is operational making a mistake in accounting or technology, not credit risk or liquidity risk. And this structural stability is precisely why the government relies on them and why they are designated as a systemically important financial institution, a sci-fi.
Ah, sci-fi. Let's pause on that term. For you, the listener, what does sci-fi status mean in real-world terms?
It means the federal government has formally determined that BNY Mellon's failure would trigger a global financial collapse.
So they're too big to fail.
They are deemed too interconnected, too crucial to the flow of global capital to be allowed to fail. Now, that status requires additional regulatory oversight and capital requirements, but it underscores that BNY isn't just a business, it's an essential utility for the global economy.
Okay, so if we look at the present, we see the company signaling a move toward simplification, modernization, with its recent rebrand.
Yes, the 2024 simplification of the corporate brand to just BNY. It streamlines the corporate identity. It's aiming for clarity in a really complex landscape. So BNY Mellon Investment Management became BNY Investments. BNY Mellon Wealth Management is now BNY Wealth. And BNY Mellon Pershing was shortened to BNY Pershing.
And speaking of physical presence, an institution this massive must have a huge footprint, but its headquarters have been a little restless in Manhattan.
The headquarters have seen frequent moves, yeah. They sold their historic home at 1 Wall Street in 2014, which led to a temporary move to Brookfield Place. By 2018, they settled into 240 Greenwich Street in Tribeca.
And this building is significant.
Very. BNY Mellon had already owned it for over 30 years under a ground lease. They eventually purchased the property outright from the city for $352 million, cementing their commitment to Lower Manhattan.
Now let's go back to the numbers that define their sci-fi status, their unique position in the market. We have two core figures, AUM and AUCA. Can you delineate the difference for us?
Sure. It's assets under management, or AUM, that's the money BNY, is actively investing and managing for clients. That's substantial. It's sitting at about $2.03 trillion as of 2024, a major asset manager.
$2 trillion. But that's not the big number.
No. The truly earth-shattering figure is the $52.1 trillion in assets under custody and administration, the AUCA.
That is nearly 25 times larger than their AUM. Why the massive discrepancy, and why does that custody number matter so much more?
Because the AUM is the money they're investing. The AUCA is the money they're safeguarding and accounting for.
Okay.
Think of BNY as a global financial librarian, not primarily a stock picker. They hold the titles, they collect the dividends, they handle the regulatory reporting, and they ensure the ownership trail is clean and correct for those $52.1 trillion in assets.
But so they don't own the money.
They don't own it. They are the neutral, trusted third party that's required for the institutional financial world to even function.
So who trusts them with this colossal responsibility?
Their client base is a who's who of global finance. BNY serves over 90% of Fortune 100 companies. They service nearly all of the top 100 global banks. And critically, they are the custodians safeguarding the retirement assets of millions of people globally, working with over 90% of the top 100 pension plans.
So their stability is quite literally tied to the retirement security of a massive chunk of the global workforce.
Exactly. If BNY is the essential utility, the quiet backbone of global capital markets, its operational stability is a global necessity, not just a corporate goal.
So if we strip away the history and these huge numbers, the fundamental question for you, the listener, is still, what exactly does a custodian bank that manages $52 trillion do every single day?
Their daily work is this highly specialized, high-volume process of helping clients manage, move, and safekeep their assets. It's the entire financial life cycle. They are the fiduciary partner that holds the securities, manages the cash movements, and handles all the intricate administrative tasks associated with these enormous, complex portfolios.
They're the enabler.
They are the essential enabler of cross-border institutional wealth transfer and ownership.
It sounds like a vast menu of services far beyond simple banking.
It's exhaustive. It covers the entire back and middle office of institutional finance. You've got asset servicing, alternative investment services, so handling complex private equity and hedge fund administration.
You are.
Broker-dealer services, corporate trust services, treasury services, global collateral services, foreign exchange, securities lending.
Right.
The list goes on.
Let's clarify a couple of those specialized roles.
Yeah.
What does corporate trust services involve, for instance?
Corporate trust is it's essentially acting as a neutral administrator for debt issuances. So when a corporation or a government issues bonds, BNY acts as the trustee.
The middleman.
They manage the interest payments, the principal repayment. They make sure all the covenants of the bond are met. They're the entity that the bondholders trust to mediate the relationship with the issuer. They literally safeguard the contract.
Okay, now let's look at the simplified segments after that 2024 rebranding. First up, BNY Investments, the asset management group.
BNY Investments is managing that substantial $2 trillion AUM we just talked about. They operate through these specialist, distinct firms under the BNY umbrella Dreyfus Insight Investment Mellon Investments Corporation.
And each one has a different focus.
Exactly. Each provides expertise across different asset classes, different strategies, different geographic markets.
Next, we have BNY Pershing. We noted earlier they're the largest clearing firm for stock trades. This really sounds like the engine room.
It is the engine room. It provides the foundational back-end infrastructure for thousands of wealth management firms and institutional investors. Pershing provides the essential clearing, custody, trading, and settlement services.
So they handle the logistics.
They handle the complex logistics of transferring ownership and ensuring funds settle correctly after every single trade, along with extensive middle and back office support.
And Pershing has been aggressively pushing innovation recently to maintain that critical infrastructure role.
Absolutely. One key innovation came in 2023 with the launch of the wealth management platform Wove by Pershing X.
Whoa.
Wove is designed to be this unified, open architecture solution that integrates the client experience with the core clearing, custody, and settlement infrastructure. It's an effort to modernize that whole advisor-client ecosystem.
And linking back to the technology push, they also added real-time payments to the Pershing Investor Portal.
That's a key integration. It speeds up transactions for those high-end clients. And it shows how this technological transformation we're about to discuss isn't just for their biggest institutional clients. It filters down into the private wealth side as well.
Which brings us to BNY Wealth, focusing on high-net-worth clients and families.
Right. BNY Wealth handles the private banking, the estate planning, and comprehensive family office services for high-net-worth individuals. As of 2014, BNY Wealth ranked as the 7th largest wealth management business in the U.S., and they continue to grow that by expanding staff and opening new offices to cater to this immense pool of private wealth globally.
Managing $52 trillion, moving $1.6 trillion in daily payments, that sheer volume required a massive internal shift in how they handled information and technology. It can't be done on old servers.
You can't. The technological transformation is crucial for maintaining that status as the global central nervous system. In 2013, BNY began building a brand new IT system called NXN.
And this wasn't just an upgrade.
No. NXN was a complete multi-year transformation toward modern architecture. It was essentially channeling Silicon Valley development practices into the world of custodial banking.
So what does that mean? What did they build?
NXN utilizes open source technology. It incorporates an API store, advanced data analytics, and it all runs on a comprehensive cloud computing environment.
Okay, what does that buzzword API store mean in practical terms for BNY's institutional clients?
An API, an application programming interface, is like a digital bridge. For BNY, the API store means their vast stores of data and transaction capabilities aren't trapped in these proprietary legacy silos anymore.
So their clients can connect directly.
Their institutional clients, pension funds, insurers, they can build custom software applications that plug directly into BNY's core systems to access their data, perform complex analytics, or initiate transactions seamlessly. It turns BNY's infrastructure into a customizable platform.
That scalability is essential when you consider the next major technological push, real-time payments. BNY was at the forefront of changing how money moves in the U.S.
They absolutely pioneered this movement. For decades, the U.S. payment system was slow. It was cumbersome, measured in hours or even days. That changed dramatically in November 2017.
What happened?
BNY Mellon executed the U.S. banking industry's first live real-time payment transaction using the clearinghouse system, or TCH.
That must have been a highly symbolic moment.
It was. A nominal amount was moved between accounts at BNY Mellon and U.S. Bancorp in just 3 seconds. This event inaugurated the first new payment clearance and settlement system for the U.S. in over 40 years.
It was proof of concept.
Total proof of concept that immediate, 247, 365 payment capabilities were possible. So they weren't just participating. They were setting the pace and demonstrating the functionality for the entire industry.
And that commitment continued.
Correct. Into 2023, when BNY Mellon became an early adopter of the Federal Reserve's own instant payment rail, FedNow. By supporting both TCH's network and the FedNow service, BNY cemented their position as a central infrastructure provider essential for this new era of rapid, immediate financial movement. It just shows that despite their 18th century origins, their future is entirely reliant on cutting-edge financial technology.
And here's where the tension between trust and turbulence really comes to the forefront. For a company that exists purely on the concept of safekeeping and trust, BNY has faced some monumental legal and security issues, many tied directly to its global reach and the sheer scale of the money it touches. We have to start with the complex money laundering scandal, sometimes referred to as Russiagate.
This was a major, complex crisis point in the late 1990s. It was all set against the backdrop of post-Soviet privatization chaos in Russia. The core of the scandal involved a network run by rogue employees
Inside the bank.
Specifically, Ludmila Lucy Edwards, a vice president working out of the bank's London office, and her husband, Peter Berlin, who operated a network of shell companies.
So what was the mechanism for moving this illegal money, and what was the ultimate scale?
The operation moved a staggering amount, over $7 billion, via hundreds and hundreds of wire transfers. This money originated from various distressed Russian banks like Inkombank, Menatep, Alfa Bank, and Sobin Bank.
And how did they watch it?
Edwards and Berlin funneled it through these offshore shell companies, primarily Benex International and Bees Lowland, which were set up specifically to wash the funds through the New York system.
And the sources reveal this wasn't just typical white-collar crime. It got entangled with allegations of international organized crime.
That's the most alarming part. Our sources quote Joseph Reisis, also known as Ogre, who was associated with the Russian mafia's Solntsevskaya Bratva. Reisis explained to Italian prosecutors in 1997 that a shocking 90% of the money flowing through the Benex accounts at the Bank of New York was Russian mafia money.
90%.
90%. That just speaks to how vulnerable the global financial infrastructure was to organized crime operating under this veneer of legitimacy.
And the scope of internal complicity was terrifying.
It was. Svetlana Kudryavtsev, who was responsible for the proper operation of the Benex accounts in New York, she received monthly payments from Edwards for her services. She refused to cooperate and resigned during an internal audit, though she was later indicted. The money just flowed for years. I mean, $4.2 billion alone passed through the Benex accounts between October 98 and March 99.
So how was this massive scandal ultimately resolved legally?
Well, the U.S. federal investigation, which started way back in 1996, was finally settled in 2005 for $14 million.
That seems small.
It does. Separately, the Russian government filed a massive lawsuit against the Bank of New York in May 2007, originally claiming $22.5 billion in damages. That highly publicized lawsuit was eventually settled in September 2009 for a much smaller, undisclosed figure, though estimates suggest it was around $14 million again.
Okay, moving to another area of major turbulence.
Yeah.
The foreign currency exchange fraud allegations brought in 2011, which led to a record settlement. And this involved the systematic deception of their own clients.
Including major pension funds?
Yeah.
This involved parallel civil lawsuits filed by both the U.S. Justice Department and the New York Attorney General. And the allegation was just profoundly damaging to BNY's reputation as a fiduciary. They were accused of systematically deceiving pension fund clients by manipulating the foreign exchange prices assigned to them.
How did this margin-stealing manipulation work? Especially given that these pension funds were supposed to trust BNY.
Let's use an analogy. Imagine you hired BNY as a concierge to buy millions of shares in a foreign currency for your retirement fund. Instead of buying it at the best rate they could achieve for you, the bank allegedly selected the day's absolute lowest rates for currency sales and the highest rates for currency purchases, and then deliberately appropriated the difference, the entire spread, as corporate profit.
So they were basically treating the pension funds as counterparties to be arbitraged against. They were exploiting the trust that's inherent in a custody relationship.
Exactly. This deceptive scheme was alleged to have generated a staggering $2 billion for the bank over more than a decade at the direct expense of millions of Americans' retirement savings.
$2 billion. That is a colossal figure. How did the bank finally resolve this?
Initially, they defended themselves very aggressively, but the legal pressure, spanning multiple state and federal jurisdictions, it proved insurmountable. In March 2015, the company admitted to facts concerning the misrepresentation of FX pricing and execution. They agreed to pay a total of $714 million to settle the related lawsuits. And that included a $180 million payment to settle a specific FX-related lawsuit just 2 months later.
So if the financial scams weren't enough, BNY Mellon also suffered a shocking and massive personal data security lapse.
Yeah, in February 2008, BNY Mellon suffered a severe security failure when backup tapes containing personal records were lost. The scale was initially reported as 4.5 million individuals.
Which is already huge.
But subsequent investigations revised that figure upward to an astonishing 12.5 million affected individuals. And this lost data included highly sensitive information like social security numbers and bank account information.
And the handling of the incident was compounded by a severe delay in transparency.
Precisely. The breach occurred in February 2008, but the incident was not reported to the authorities until May 2008. The letters informing the affected individuals didn't go out until May 22nd, which highlights this critical lack of timely transparency in a situation involving millions of Americans' core personal data.
And beyond these high-profile scandals, BNY has settled several other significant legal actions, confirming a pattern of regulatory issues across different functions.
Yeah, they settled foreign bribery charges with the SEC in 2015 for violating the Foreign Corrupt Practices Act.
What was that about?
This violation involved providing internships to relatives of officials at a Middle Eastern investment fund. It was a type of quid pro quo designed to win business. That was settled for $14.8 million. They also settled a securities lending lawsuit with South Carolina's pension fund for $34 million in 2013.
And there's one more key concept we need to define to contextualize a 2018 settlement: American Depositary Receipts.
An American Depositary Receipt, or ADR, is a certificate issued by a U.S. bank that represents shares in a foreign stock. It just allows U.S. investors to trade foreign stocks easily.
Okay, so what was the issue?
In 2018, BNY agreed to pay nearly $54 million to the SEC for improper handling of pre-released ADRs. This scheme essentially created synthetic, unauthorized ADRs, allowing investors to borrow shares they didn't really own and creating market imbalances.
So for a firm that prides itself on being the seamless technological engine room of finance, the sources also document major operational failures related to its core IT systems, the very plumbing we discussed earlier.
And these failures expose the inherent risk of running a CFI on incredibly complex interconnected technology. In August 2015, during a software change, there was a complete breakdown of their SunGuard accounting system.
And the result was catastrophic for institutional clients.
Catastrophic. The system was unable to calculate the net asset value, or NAV, for 1,200 mutual funds.
And the NAV is the price.
It's the critical price point institutions use to buy and sell funds. Without it, the market effectively freezes. BNY had to resort to manual calculation until the system was fully operational a week later. And that failure, and the lack of a sufficient backup plan, resulted in a $3 million settlement with the Massachusetts Securities Division.
And this wasn't an isolated incident demonstrating the high operational risk they faced.
No. In December 2016, BNY Mellon suffered another major technology issue that prevented it from processing payments related to the global SWIFT network for a critical 19 hours. At the time, the bank was processing about $1.6 trillion in payments daily.
A day.
That outage caused a massive backlog and required an unprecedented extension of the Fedwire payment services. When you operate at this scale, the smallest glitch can become a global crisis.
Now let's shift from high finance and trillion-dollar crimes to a much more relatable, almost ironic controversy involving their real estate in Manhattan. This is the dispute over the POPS agreement, the privately owned public space.
This is a fantastic anecdote that speaks volumes about corporate culture. So when BNY Mellon constructed its 101 Barclay Street headquarters, now 240 Greenwich, it made a classic New York City trade-off.
Right.
The city granted them a permit allowing modifications to height and setback regulations, which saved them millions in construction costs.
And what was the trade-off? What did the public get?
A critical public amenity. They promised a lobby accessible to the general public 24 hours a day, a privately owned public space, or POPS. This was supposed to be a public benefit in exchange for that favorable zoning.
So you're telling me the oldest bank in America, the ultimate fiduciary, The institution that manages $52 trillion
Mhm.
spent 15 years actively fighting to prevent citizens from using a fancy lobby they had promised the city.
That's precisely the finding of a 2017 audit by the New York City Comptroller. Auditors found BNY Mellon had been in violation of this POPS agreement for at least 15 years, with the bank's security personnel actively preventing auditors and the general public from accessing the promised lobby.
15 years of actively flouting a local public agreement. It speaks to an institutional disregard for regulatory agreements, even at the micro level.
It does. And while the company did begin to permit partial public access in September 2018 under legal pressure, the audit noted that BNY Mellon still remained in violation because the agreement requires access 24 hours a day, not just during business hours.
And it continued.
As recently as early 2021, city auditors were still being prevented from entering or photographing the lobby by security personnel, with the bank actively seeking to have the public lobby designation removed entirely.
Wow. Despite these extensive operational and legal challenges, the company also demonstrates a significant and highly publicized focus on corporate culture, sustainability, and ESG goals. It creates this very complex, contradictory picture.
It is a deliberate effort to balance their opaque technical role with public visibility and corporate responsibility. On the sustainability front, BNY Mellon has received high marks, including A ratings from CDP for its climate change disclosures. By 2014, they had saved $48 million due to building efficiency and maintained multiple LEED certifications for their real estate.
They also seem to put a strong emphasis on internal diversity and inclusion, which is essential for attracting and retaining talent in a highly technical field.
Absolutely. They foster multiple internal business resource groups focused on different employee demographics. You have WIN, the Women's Initiative Network, PRISM for LGBT employees, Impact for multicultural employees, and VetNet for veterans and military employees. This internal structure is crucial for a global firm.
In reflecting a focus on employee support, there was a notable increase in the minimum wage recently.
In 2023, BNY increased its minimum wage for U.S.-based employees by a substantial 12.5%, raising the hourly rate from $20 to $22.50. They also expanded their mental health resources for employees, recognizing the need to support their workforce in a high-pressure industry.
Their investment research initiatives also show an interest in global economic inclusion, particularly around gender and capital.
Their 2022 report, The Pathway to Inclusive Investment, surveyed 8,000 global respondents. The key finding was a remarkable projection. If women were to invest at the same rate as men, closing that gender investment gap could unlock an estimated $3.2 trillion in additional capital globally.
Wow.
It shows BNY leveraging its research capabilities to promote market growth through inclusive practices.
And finally, we see their efforts to build brand awareness and connection, using sponsorships to make the BNY name more familiar to the general public.
BNY uses sponsorships strategically to demonstrate global and cultural engagement. They were the title sponsor of major international events like the Oxford and Cambridge boat race for a few years, and they continue to sponsor the head of the Charles Regatta.
And in the U.S.
Domestically, they partner with major sports teams like the San Francisco 49ers and Levi's Stadium. They also support cultural institutions like the Royal Academy of Arts in London and the Perelman Performing Arts Center in Lower Manhattan. It's a carefully crafted effort to make the plumbing visible and relatable.
What a phenomenal journey we've taken through the history of American finance. I mean, we've gone from Alexander Hamilton setting up shop in a New York coffee house in 1784 and fighting Aaron Burr to the modern BNY today, grappling with real-time payment technology, the cognitive burden of safeguarding $52 trillion, and these massive legal settlements for things like foreign exchange fraud that impacted millions of pension holders.
The tension between the 18th century conservative origin story and its current role as a sophisticated, systemically important powerhouse, that's a central, enduring theme. Understanding BNY is key to understanding the quiet mechanics of the global financial system. Its immense custody assets mean it acts less like a traditional lending bank and more like the central nervous system for the world's wealth. It's just processing transactions and ownership records at a volume few can comprehend.
And the fact that they consistently pass federal stress tests, despite the occasional major IT outage or global scandal, that provides some measure of comfort. Their stability is critical to the world economy. The scale of their responsibility makes both their demonstrated stability and their documented controversies equally significant for global finance.
And that thread of high-stakes friction, it runs straight from its founding. We saw Alexander Hamilton and the founders vigorously oppose Aaron Burr's attempt to break their monopoly in 1799, a conflict for economic control. 2 centuries later, we see BNY settling massive money laundering suits tied to organized crime and paying record-breaking fines for currency fraud that impacted those very same pension funds they were sworn to protect.
Which raises an important question for you, the learner, to consider as you wrap up this deep dive. If the oldest bank in the U.S. has always been entangled in these fundamental political and controversial financial battles, from its founding opposition to Burr's political challenge to settling near-billion-dollar suits over the integrity of currency trading, does this suggest that such high-stakes friction and controversy are simply an intrinsic, enduring quality of being a systemically important global financial institution? It seems that wherever the world's wealth flows, BNY is there, and conflict follows.
Something to mull over as you contemplate the $52.1 trillion currently under their watch, quietly ensuring the gears of global capital keep turning.